How well do you really know your rental portfolio? Like, really? Hi, I'm Megan. I love investing in rental properties, and I believe in running my rental portfolio as a business. So today I wanted to discuss 5 metrics that I think every rental property investor should be tracking to really truly understand their business. Metric number 1 is your net cash flow after reserves are set aside. Most of us know that when we're running numbers for a potential new purchase, we want to set aside some amount of money in reserves. This might mean that you're setting aside 5% of your monthly rents to go into some reserves account. But once you actually get that property up and running, are you actually setting that money aside in that separate account every month? And even if you are you pulling that number out of your cash flow reports every month? Because your QuickBooks tracking probably won't show that as an expense to you. That's just a transfer you're making between your own accounts. But that money is earmarked for something that can and probably will hit in the future. So you want to understand what your true cash flow is after you're setting aside reserves, because this is telling you what you can actually live on from your rental portfolio. So the equation here is your rental income, your gross rental income, minus operating expenses, minus your debt servicing if you have a loan on it, minus your reserves set aside. That's what equals your true net cash flow. Metric number 2, principal paydown. When you're calculating your net cash flow every month, that principal payment is an expense to you. It's coming out of your accounts. However, that principal amount is building your net wealth over time, your net worth. It's increasing your equity in your properties. You also have appreciation happening, but that principal paydown is really powerful because it's getting you closer and closer to owning that asset free and clear thanks to your tenants paying off your loans. So I love every month to look at how much money went to my net worth in the form of principal paydown. And in most cases, you've got an amortized loan where the amount of interest and principal changes over time as you pay down the principal. So that principal amount that you pay goes up every single month over the life of the loan. So it's important to track it every single month, see how that's building. Then at the end of the year, you can look at how much in total you paid down debt, which increases your net worth by that amount. So if you are paying over the course of a year, you average $2,500 per month in principal paydown, that's $30,000 towards your net worth every single year just by running that property well and allowing the tenants to pay down your debt for you. And that becomes really powerful in a matter of just a few years. Metric number 3 is your operating expense ratio. So this one's really important because you want to understand how efficient you are at running these properties. And if you've got a high operating expense ratio, it's either that you're not running it efficiently, or maybe it's the building is really old. It needs a lot more work done to bring it up to speed. It's maybe just not in a great place where the rents are really worth it. Maybe it's a property that is better to sell or 1031 exchange into another one. So your operating expense ratio can really tell you how well a property is performing over time. And the way that you measure this is you take your total operating expenses across your portfolio, and that means the expenses not including your debt servicing, so not including principal and interest, and you divide that by your gross monthly rents, or if you're looking across the year, your gross annual rents. And what I've heard and what I've seen in my portfolio and from other investors I know is that you want to be keeping your operating expense ratio at or below 50%. So you don't want to be spending more than half of your monthly rent or your annual rent on those expenses. This is important because even if you pay down all of your loans and you own all your properties free and clear, if you have a really high operating expense ratio, you're still not going to cash flow very well. So make sure you're tracking that. And if you see that it's high, it's way above 50%, you know you need to do some digging and figure out what you need to fix in how you're operating your rentals. Metric number 4 is your maintenance cost per unit. And generally you're going to look at this annually because obviously this changes and fluctuates each month. But this is really drilling down. So your operating expense ratio tells you overall what your non-debt servicing costs are to run your property. But the most variable of those costs is your maintenance and repairs each month. So you know your taxes and insurance will stay pretty steady month after month. Utilities will probably mostly be pretty steady. Lawn care will probably be fairly steady through the months that you need to pay that. But those maintenance requests, those repairs that pop up, those can really vary quite a bit. So understanding how that averages out over time across your entire portfolio can really help you budget better going into future years. So the equation for this is taking your total annual maintenance costs and dividing it by the number of units you have. So if you have $24,000 in maintenance costs per year and you have 24 units, that's $1,000 per year per unit. That's a pretty big expense every single year on each unit. So that's probably an entire month of rent for each unit. So that's pretty high. You want to understand that versus I hear a lot of investors say that they plan for $250 to $500 per year per unit. So this again helps you understand how efficient your units are, how well kept they are, and how many of these issues pop up that you need to budget for. Metric number 5 is your average tenant stay. So we all hear people talk about vacancy rates and understanding how many weeks or months per year you have units empty. Sometimes it's physical vacancy, meaning there's people are not in the units. Other times we're talking about economic vacancy. People might be in the units, but they're not paying. However, I like to look at average tenant stay because I think it's a really good indicator of tenant happiness and how well I'm running my properties. If I constantly have tenants moving out every single year and I'm just constantly turning it over, it's a lot of vacancy costs and turnover costs for me, but it also means I'm probably not running my business very well. My customers are not happy. So I do want to see higher than 12 to even 24 month average tenant stays personally. So the way you measure this is you look at all of your tenants that you have in place right now, how many months each of them have been in their units. You add all of that up and then you divide it by the number of units. So for instance, if you have 3 units and one tenant has been in place for 36 months, another has been in place for 24 months, and another has been in place for 18 months, you add those all up, divide it by 3, that gives you an average tenant stay of 26 months, a little over 2 years, which I think is a really solid place to be in terms of tenant happiness and tenant retention. Now, if you go really high, if you consistently have tenants for 4, 5, 6 years, it's not necessarily a bad thing, but you should double check how you are in terms of your actual rents versus market rents. Are these tenants staying in place just because they're super happy even as you raise rents every single year? Or are you not raising the rents enough so they're staying in place and you're actually leaving a ton of money on the table? I do believe in keeping good tenants in place. I enjoy tenants staying for a long time, and I'm willing to give on a little bit of rent to do that, but I don't want to be massively underperforming the market and leaving a ton of money on the table, because this is also how I feed my family. So it's a balancing act, but I think average tenant stay is a really good metric to be watching in your business. So there you have it, 5 metrics to track to really understand your business. Understanding your business means you can run it better. It means you understand how it's supporting your life and if it's achieving the goals you set out to achieve. So I really believe in tracking things in your business and running it like a business. Let me know in the comments below if there are other key metrics that you'd like to track for your rental portfolio. Please subscribe, share this video with anyone who you think would benefit from it. And as always, keep learning, keep growing, and have fun.